Imagine a bank that absolutely loves risk. Like they purposely lend out billions of dollars to people with less than perfect credit.
Right, which sounds crazy.
It does. And they charge zero interest on a huge chunk of those loans. But yet somehow they boast a lower default rate than some of the, safest legacy credit card issuers out there.
I mean, it completely breaks the traditional rules of finance, right? When you look at those variables on paper, high-risk borrowers, zero interest, mass scale, that institution should theoretically be bankrupt in a week.
The math just shouldn't work.
No, it really shouldn't.
But they aren't bankrupt. They are thriving. And today we're doing a deep dive into the internal financial data that proves this isn't just some theoretical model.
Yeah, the real numbers.
Exactly. So we're looking at the May 7, 2026 earnings presentation and the financial data from Affirm, the absolute titan of the buy now, pay later space.
The BNPL giant.
Right. Specifically, we're looking at their fiscal year 2026 Q3 results. And for you listening, while this might just look like a stack of corporate financial slides, it's actually it's this massive mirror reflecting exactly how our shopping habits are fundamentally rewiring the global economy.
Oh, absolutely. The sheer scale of what they're processing is staggering.
It really is. Just rattle off the headline numbers to establish the scale here. In just this one quarter, Affirm's gross merchandise volume the total dollar amount of stuff people bought through their platform hit $11.6 billion.
Billion with a B.
With a B. That is a 35% increase year over year. Active consumers jumped 22% to 26.8 million people, and total revenue reached $1.039 billion, up 33%.
When you see sustained growth rates in the 30s for a company that's already operating at a multi-billion-dollar baseline, you're witnessing a platform that has moved way beyond a niche financial tool.
Right, it's not just a feature at checkout anymore.
Exactly. It's acting as a primary economic engine for millions of households.
Hold on, though, because that brings up something that completely defies standard retail logic in this data.
The cart sizes.
Yes. If the platform is growing by 35% and moving $11.6 billion, logic dictates that consumer shopping carts are getting bigger and bigger, but you're telling me they're actually shrinking.
Yeah, it's entirely counterintuitive. You would assume the massive volume comes from bigger purchases, but the average order value, the AOV, is actually dropping.
Wow.
Yeah, it fell from $293 back in Q3 of 2023 all the way down to $255 here in Q3 of 2026.
See, if I'm running a traditional retail store, a shrinking cart size is a 5-alarm fire.
Yeah.
I want people buying more per visit, not less. So how does a dropping order value equal $1 billion in quarterly revenue?
Well, because Affirm isn't a traditional retailer, right? They're an ecosystem. For them, a shrinking order value is the ultimate victory of integration.
Okay, unpack that a little.
Think about the friction of a transaction. When Buy Now, Pay Later first started, it was primarily a destination for big-ticket items. You bought a $2,000 Peloton or a couch, and you needed a way to spread out that massive payment.
Right. It was a planned, high-friction financial decision.
Exactly. But look at what's replacing that couch in the data.
Oh, the Affirm card.
Yeah.
The physical and virtual cards are seeing explosive growth. Card-active consumers grew an unbelievable 130% year over year. They hit 4.4 million users.
Yeah, it's a huge jump.
And the card attach rate, which is basically how often people are opting to use the card within the Affirm ecosystem, leaped from 7% up to 19%.
And there's your paradigm shift. By pushing the Affirm card and embedding themselves at the physical point of sale, they've completely normalized their service for small, everyday purchases.
So you're not just financing the couch anymore.
No, you're using the app for your morning coffee, your weekly groceries, the daily essentials. By becoming a permanent fixture in the daily wallet, they trade that rare $2,000 transaction for, dozens of $40 transactions.
So it's like replacing a single, incredibly expensive steak dinner with 100 trips to the drive-thru.
That's exactly it. They are trading occasion for frequency.
And frequency builds habit.
And habit builds a massive moat around our business.
Well, the numbers definitely back up that habituation. I mean, we're looking at a 96% repeat customer rate.
Which is a marketer's dream.
96%.
Yeah.
That much of their transaction volume comes from people who've used the service before. And transactions per active consumer are up to 6.7. But I'm looking at what they're actually buying with these 6.7 transactions, and it makes me a little nervous.
Oh, why is that?
Well, the general merchandise category, so standard retail goods, is slowing down. It only grew 12%. Meanwhile, home and lifestyle exploded by 43%. And here is the real red flag for me. Services jumped 53%. and a mysterious other category skyrocketed by 99%.
You see those service numbers as a red flag.
Absolutely. I mean, I have to push back on this strategy a bit. It's one thing to finance a flat-screen television. If the consumer stops paying, the television is a physical asset, right?
Technically, sure.
But a 53% jump in services. Are people literally financing their plumbing repairs or like their haircuts in 4 installments?
Yes, they are.
But if someone defaults on a haircut, a firm can't repossess it. There is zero collateral. Doesn't that make this a wildly dangerous category for them to lean into?
It sounds incredibly dangerous if you look at it through the lens of traditional lending, but that requires a misunderstanding of consumer psychology in 2026.
Okay, so what's the psychology then?
We have to look at the other metric you mentioned. Their short-term pay and X products, the ones with 0% interest. Those grew by 52%. That tells a very specific story about the modern borrower.
Which is what? That they're desperate for cash.
Not desperate, hyper-calculating. Consumers are highly intelligent, and they aren't viewing this as taking on debt in the traditional sense. They're using it as a sophisticated cash flow management tool.
Oh, interesting.
Let's use your plumbing example, right? If your pipes burst and the repair costs $400, you might actually have $400 sitting in your checking account. But if you can pay $100 today and spread the remaining $300 over 6 weeks with absolutely 0% interest, why wouldn't you?
Right, because then you keep the remaining $300 liquid for groceries, gas, or other immediate emergencies.
Precisely. You prioritize zero-interest cash flow flexibility over, say, putting that emergency repair on a traditional credit card that might immediately hit you with a 24% annual percentage rate.
Oh, wow. Yeah.
The fact that services and other are exploding proves the platform's utility has completely transcended retail shopping. It's entered into the realm of essential life management.
Let's make sure we understand the underlying physics of this, though. Because, okay, consumers love zero interest. But Affirm is a publicly traded company. They are not a charity.
Definitely not.
If I pay 0% interest on that plumbing repair, Affirm isn't making a dime off me. So how on earth do they translate millions of small, zero-interest consumer transactions into $1 billion in quarterly revenue?
Because they don't make the money from you, they make it from the plumber.
Okay, explain the mechanics of that.
So the revenue model relies on the merchant subsidizing the consumer's interest. Affirm's revenue as a percentage of total gross merchandise volume is rock solid at around 9%. That means for every $100 moving through their entire system, they capture about $9.
Right.
But you aren't paying that $9. The merchant is paying Affirm a fee to process the transaction.
Wait, but why would a merchant agree to give up a chunk of their profit margin just to let someone pay in installments?
Because Affirm guarantees the sale. If you walk into a store and see a $1,000 price tag, you might walk right back out. But if you see a button that says, pay $250 today, you make the purchase.
The conversion rate.
Exactly. The merchants want that higher conversion rate at checkout. They're happy to pay Affirm a fee because Affirm is bringing them customers they otherwise would have completely lost.
And the data actually shows that merchants generating over $1,000 in volume for Affirm grew by 41%. So the merchants are clearly seeing the value.
Oh, they definitely are.
Although it's worth noting that Affirm isn't like squeezing the merchants harder. Some fee rates have actually dropped slightly. For example, the core 0% lawn merchant fee dropped from 12.5% to 11.5%.
Right, and Affirm can afford to take a slightly smaller slice of the pie from the merchant because the pie itself is growing exponentially. But the real magic trick of their business model, the thing that drove them to over $1 billion in revenue, isn't just the merchant fees, it's the radical collapse of their expenses.
Oh man, the expense data is wild. Their sales and marketing costs have just aggressively collapsed.
It's fascinating.
They went from eating up 23% of revenue down to just 7%, which is roughly $73 million. At the same time, they are keeping their foot on the gas for tech and data analytics, holding that steady at 18% of revenue.
Slashing marketing from 23% to 7% while simultaneously growing revenue by 33% is almost unheard of in consumer tech.
It's like a toll road where the owners have completely stopped paying for highway billboards because the car dealerships in town are now legally required to give out maps with the toll road highlighted in neon.
That's a great way to put it.
Affirm doesn't have to buy your attention anymore. The 96% repeat customer rate means the users are already there and the merchants are doing the rest of the selling for them at the checkout page.
And that efficiency is what transformed their balance sheet. Because of those collapsing marketing costs, their GAAP operating income swung from major losses just a few years ago to a positive $88 million in Q3 of 2026.
Wow.
And their adjusted operating margins hit an impressive 27%.
Wait, before we celebrate those margins, let's clarify something for the listener. For those of us who don't read accounting ledgers for fun, what is the actual difference between GAAP operating income and adjusted operating margins? Why do both matter?
Oh, sure. It is a crucial distinction. GAAP stands for Generally Accepted Accounting Principles. It's the strict, standardized way regulators require companies to report their finances.
Right.
The catch is that GAAP includes massive non-cash expenses, primarily stock-based compensation for employees. It makes a company look less profitable on paper because they're handing out stock options, even though actual cash isn't leaving the bank account.
Okay, so when they report a positive $88 million GAAP operating income, that is a massive milestone.
Exactly. It means their core business machine is generating so much raw cash from merchant fees that it completely out-earns even those heavy standardized accounting burdens.
Got it. And the adjusted operating margin.
Adjusted operating margin strips out those stock compensations to show you the pure operational cash efficiency of the business. Hitting 27% there proves the underlying engine is wildly profitable.
The engine's profitable, yes.
Ah,
But transitioning from the profit to the product, at the end of the day, the product is still a loan.
right.
The merchant's already been paid, and they don't really care if the borrower defaults. Affirm cares. Affirm takes the hit. So we have to look at the risk profile of who is actually receiving these billions of dollars.
In any lending business, risk assessment is the only thing that ultimately keeps the lights on.
And Affirm's portfolio is alarming at first glance. The data shows that 43% of their assets are categorized as non-prime.
Which is high.
Very high. In the real world, non-prime means nearly half of the people using this service have credit scores or financial histories that traditional banks consider risky. They might have missed payments in the past or have high debt-to-income ratios. To put that 43% in perspective, Affirm's peers in the consumer lending space sit comfortably between 27% and 41% non-prime. Affirm has the highest proportion of risky borrowers.
So a traditional analyst would expect an avalanche of defaults.
Which is why I'm staring at these numbers and it feels like a glitch. Affirm's 30-day plus delinquency rate. So the percentage of people who are more than a month late on a payment is holding perfectly steady at around 3%.
Yeah.
Meanwhile, one of their main competitors, labeled in the internal data as Issuer B, has a delinquency rate sitting all the way up at 6%. So I needed an explanation for this math. How is it physically possible that Affirm serves the highest proportion of risky non-prime borrowers, yet their late payments are literally half the rate of competitors with much safer portfolios?
It comes down to the physics of loan duration. Traditional credit scoring relies on measuring the probability of default over a long timeline.
Break that down. How does the timeline change the risk?
Consider a traditional credit card. You buy a $1,000 television, you put it on the card, and if you only pay the minimum balance, that debt can sit there for 5, 7, maybe 10 years.
Right, the interest just compounds relentlessly.
Exactly. But more importantly, the risk of a life event happening during that massive window, sudden job loss in year 3, a medical emergency in year 4, is incredibly high. Those macroeconomic shocks are what cause people to default. The risk compounds over time. Time is the enemy of debt repayment.
And Affirm removes time from the equation entirely.
Precisely. The data shows that the average life of an Affirm loan is incredibly short, just 10 to 11 months. The risk literally does not have the runway to compound the way it does on a traditional credit card.
That makes so much sense.
It is a highly controlled, closed-ended installment. It cycles out and is paid off before major, unpredictable life shocks can fully derail the borrower's ability to pay back a few $100s. They're assessing your ability to pay over the next 40 weeks, not the next 40 years.
So because the loan is gone in 10 months, they're basically outrunning the risk. But they still have their tech and data analytics spend held high at 18%. I imagine that's to assess the specific risk of that specific 10-month window instantly at checkout.
Exactly. They're managing risk in real time, transaction by transaction, rather than relying solely on a static 10-year-old credit score.
Even with that real-time management, building a business on non-prime borrowers means you have to be ready for the economy to turn sour. And the data shows they're clearly hoarding cash for a rainy day.
Yes, they are.
They've aggressively increased their allowance for losses to $512 million. That represents 6.0% of their held loans. So even though their actual delinquency is sitting low at 3%, They're stockpiling $500 million to protect against future defaults.
They're building a financial fortress. You don't stockpile $500 million unless you are anticipating broader economic headwinds on the horizon.
And they're also proving they can manage specific vendor risks when those headwinds hit. Like back in fiscal year 23, the legacy loans tied specifically to Peloton equipment saw 30-day delinquencies spike up to 3.2%. It was a real concern.
Right.
But today, the data shows that specific portfolio has stabilized and is projecting back down around 2.5%. They are constantly adjusting the internal dials.
And that strategic awareness, knowing exactly how to manage a high-risk, high-frequency user base, is what's fueling their aggressive future outlook.
Speaking of that outlook, building a $500 million fortress implies they know a storm might be coming, but it also means they have the capital to travel. Let's look at their guidance for Q4 of fiscal year 2026.
Let's do it.
They are projecting up to $13.45 billion in gross merchandise volume for the next quarter and revenues of $1.11 billion. But hidden beneath those projections is a massive strategic shift. The data explicitly notes that one major corporate partner is actually moving away to use their own proprietary wallet solution.
Which is huge. Losing a massive corporate partner is traditionally a devastating blow to a financial platform. Wall Street usually panics.
But Affirm doesn't seem to be panicking at all, because they are explicitly targeting international expansion outside of North America as their next massive growth engine. They're taking this hyper-efficient, 10-month, low marketing cost flywheel, and they're preparing to export it globally.
Which brings all of these billions of dollars in data points right back to the everyday reality of how we interact with our own money. If you're looking at your own bank statements or spending habits right now, you might notice this exact shift. For decades, consumer loyalty was won by credit card points, airline miles, and cashback rewards, the traditional perks.
Right, the promise of a free flight to Hawaii if you spend enough money over 3 years.
Exactly. But this data proves the paradigm has shifted. Loyalty today is no longer won by points at the end of the month. It is won by cash flow flexibility at the actual point of sale. Modern consumers want control over their immediate liquidity. They want to hold on to their cash today, even if it means sacrificing a hypothetical airline mile tomorrow.
It is a total rewiring of how purchasing power is perceived. And it forces us to rethink the very foundation of how financial institutions judge us. We talked earlier about how the old system categorizes 43% of these users as non-prime, labeling them as massive risks based on traditional metrics.
Metrics that were designed for 30-year mortgages and revolving credit cards, not for a dynamic 10-month installment on a plumbing repair.
Exactly the point. So we want to leave you with a provocative thought to mull over. If a simple 10-month buy now, pay later loan structure can safely and profitably manage a 43% non-prime user base, doing it better and more efficiently than multi-billion-dollar legacy banks, are legacy credit scores actually measuring the wrong kind of risk entirely?
It's a great question.
What if the future of your financial reputation isn't an arbitrary 3-digit FICO score calculated by a credit bureau you have never even spoken to? What if your financial future is simply your real-time, everyday transaction history on a single app that knows you buy your coffee, pay for your haircuts, and manage your cash flow responsibly every single week? Think about that the next time you tap to pay.